Yahoo did not fail from a lack of opportunity. It failed from a lack of focus. This common narrative, missed acquisitions, is an incomplete diagnosis. The real story is strategic drift. A titan of the early internet lost its way, not from one miss, but from a slow, systemic erosion of its identity and direction. Not a sudden collapse, structural decay over more than a decade, masked by massive early market dominance. Opportunities were abundant, clarity was absent. Potential strengths became distracting weaknesses. This is a structural autopsy. We will look past surface-level missed acquisitions. We'll dissect the operational failures that made those misses inevitable. They pulled the company in countless directions at once. It produced a portfolio of poorly integrated assets, each competing for attention. Today we'll break down the risk signals leadership ignored. We'll use a specific model, the strategic drift meter. It evaluates three critical dimensions: directional inconsistency, acquisition misallocation, leadership instability. The promise, not just explaining Yahoo, but giving tools to fix similar drift. Signals of decline show up long before collapse. Build a more resilient, focused enterprise. To grasp the magnitude of Yahoo's fall, one must first understand the height of its dominance. In the late 1990s and early 2000s, Yahoo was not just a website. For millions of users, it was the internet. It was the default homepage. It was the primary search engine. It was the trusted source for news. It was the trusted source for email. At its peak, it was the most visited website in the world. Its market capitalization soared past $125 billion in early 2000. This was a business built on being the essential starting point for every digital journey. In the year 2000, Yahoo was generating significant revenue. That revenue came primarily from display advertising. It was a media giant and a technology powerhouse rolled into one. This was not a fragile startup or a niche player. The company's strategic position was further solidified by a series of high-profile acquisitions. It purchased GeoCities for $3.6 billion in 1999. It bought Broadcast.com for $5.7 billion that same year. It positioned Yahoo as the gatekeeper to the internet's vast landscape and the primary beneficiary of its explosive growth. It had the capital, the brand, the traffic, and the market position to lead for another decade. When a company is this dominant, the greatest threat is not an external competitor, but internal decay. And the story of Yahoo is a lesson in how quickly that dominance can unravel when strategic clarity is lost. To move beyond a surface-level diagnosis of Yahoo's decline, we need a more rigorous method of analysis. This is the purpose of the strategic drift meter, a framework designed to measure the slow systemic decay that often precedes a major corporate collapse. It translates abstract concepts like lack of focus, identity confusion, into a set of measurable indicators. The meter helps us visualize this gradual erosion by focusing on three core risk dimensions that are often overlooked in traditional financial analysis. The first measure of our meter is the directional consistency score. This metric quantifies how frequently a company changes its core strategic direction. For Yahoo, this would measure its shifts between being a media company, technology company, communications platform, advertising network. The second pillar of the strategic drift meter is the acquisition effectiveness ratio. It measures how successfully acquired assets are integrated into the core business. This was a critical failure for Yahoo. Yahoo spent billions on GeoCities. Yahoo spent billions on Broadcast.com. Those properties were left isolated instead of woven into one user experience. The third and final measure is the Leadership Stability Index. It quantifies turnover impact in key executive roles, especially the CEO. Yahoo cycled through 7 CEOs in its last 2 decades as an independent company. That level of instability made long-term execution impossible. Together, these three metrics provide a clear picture of Yahoo's structural decay. They show how a market leader dismantled its foundations through strategic drift. Section 1. Risk Dimension 1. Directional inconsistency. We define this risk as the frequent and often conflicting pivoting of a company's core strategy. A company suffering from high directional inconsistency struggles to answer the most fundamental question: what business are we in? For a company like Yahoo, this risk manifested as an inability to commit to a single identity. Was it a media company curating and creating content to sell to advertisers? Or was it a technology company building best-in-class platforms? The ignored signal was growing internal friction and a lack of a clear, unified product vision. The structural consequence was profound. It led to a bloated, inefficient organization where resources were wasted on initiatives later abandoned. Section 3. Risk Dimension 2. Acquisition Misallocation. This risk is the inefficient use of capital to acquire assets that are poorly integrated or that do not align with a coherent long-term strategy. For Yahoo, acquisitions became a substitute for focused innovation. When Yahoo fell behind, its default was to buy a solution rather than build one. The ignored signal, declining user engagement, and eventual write-downs of these assets. Leadership should have tracked one simple metric: post-acquisition growth rate versus pre-acquisition trajectory. The result was massive shareholder value destruction. It was empire building, a sprawling, disjointed collection of properties rather than a focused, defensible kingdom. Risk Dimension 3. Leadership Instability. This risk is defined as the high rate of turnover in key executive roles, most critically that of the chief executive officer. Yahoo is a textbook case. Between 2001 and 2017, it cycled through 7 CEOs, including 2 interim chiefs. Each new CEO brings a new strategic vision. This creates organizational whiplash, forcing employees to abandon previous initiatives and realign to often contradictory directions. The structural consequence was a complete erosion of trust in the company's direction. Ambitious multi-year initiatives were almost impossible to complete. In summary, the decline of Yahoo was not a story of a single missed opportunity or a sudden market shift. It was the predictable outcome of a prolonged and systemic failure to maintain strategic focus. To bridge the gap from corporate autopsy to personal application, we must translate these risks into a tangible diagnostic tool. We can do this with a simple but revealing metric: the financial focus ratio. This ratio serves as an immediate mirror, reflecting the level of complexity you are asking your organization to manage. Are you financially scattered? We call this the 3-step tactical shield, a set of concrete actions designed to restore focus and build resilience. 1. Define one primary financial objective. 2. Eliminate 2 non-essential commitments. 3. Align investments with one strategy. Clarity reduces friction. Capital needs direction. Focus compounds growth. A 30, 60, 90-day resilience plan provides a clear roadmap for implementation, moving your organization from diagnosis to structural adjustment to a state of renewed focus. This is how you build a truly resilient enterprise. Opportunity without clarity becomes distraction. Next, Lehman Brothers.